Good evening, folks. This is Carl, your ticker guy, coming at you from sunny Niceville, Florida. It's about 6:30 on the 16th of September. And why do I put the date and time on this? Well, because in about another 15 minutes, this may all change. All right, the current news is that AIG is going to be bailed out, kind of, sort of. They're going to get a bridge loan, which is kind of similar to what happens if you've got two houses. You've got a new one where you're moving, and you got your old one, and you need a mortgage temporarily, but you're not going to own two houses. So you get what's called a bridge loan, which allows you to sell your old house, move, and I got the new house. Okay? Now, normally this is a problem because you'd have to take out two full mortgages, and you can't. You don't have enough capital capacity to carry that. So you get this thing called a bridge loan. And businesses use these things once in a while, and it's for this specific purpose. It's short-term liquidity backed by some asset or some group of assets for a specific business purpose that is not expected to last very long, maybe a few weeks, a few months at most. Okay. AIG went to the Federal Reserve and asked for one of these. They asked Tim Geithner, the New York Fed president, for it. The Federal Reserve basically told them to pound sand. Well, AIG was prepared to file bankruptcy tomorrow. And the reason is that they got downgraded after their stock got pummeled into the ground. And as a result, they would have had to make a capital call for about $10 billion. And the way that works is when you've written credit default swaps, if you get downgraded, you have to post additional money because there's a greater risk that you won't be able to pay at all. So the people you wrote those swaps to want some additional security. And this is a pretty normal process. But in this case, you have a company that has a $1 trillion balance sheet. They're not broke. They just don't have any cash at the moment. They didn't happen to have $10 billion laying around that they could put out and still maintain their daily liquidity that they need to do business. And AIG is primarily an insurance company. All right, of course, credit default swaps are insurance. We just don't call them that because then we'd have to regulate them and actually participate in some margin requirements. So our regulators are so nice that they just kind of ignore the fact that credit default swaps really are insurance. We just don't call them that because that would change their legal designation. Okay. So this sounds kind of good, actually, because the government is going to supposedly get warrants, which is, for all intents and purposes, you can think of it as a conditional ability to buy stock, kind of like a call option, except that you don't need to exercise them, just like with a call option, and they're good for a longer period of time. All right. The bottom line, however, is they're very dilutive because they essentially act as additional capital stock that would be issued by the company if they're called. Now you say, well, what's the big deal with that? The government has to be protected. Here's the problem, folks. This makes any company in America that has written credit default swaps subject to bear raids. And what do I mean by a bear raid? I mean a deliberate attempt to drive that firm out of business by hedge funds and by other malevolent people. Well, this is what happens. See, I know now, because this is the second time. Remember, Fannie and Freddie had this done to them. Okay? They ended up in conservatorship, and shareholders were wiped out. Bear Stearns, shareholders were wiped out, debt holders were protected. Now we got AIG, shareholders are not going to be completely wiped out, but, you know, I mean, hey, if the stock is worth $1, what's the difference, right? Okay. So now, let's say that I want to go after Goldman Sachs or Morgan Stanley. So I get my hedge fund buddies together and I say, let's see, who wrote a bunch of credit default swaps? Let's say Goldman. We find out they wrote $500 billion worth of credit default swaps. Oh, goody. So what we're going to do is we're going to short that stock into the ground. And eventually what ends up happening is as we do that and the stock price gets low enough, you lose access to the capital markets. You can't issue preferred stock. You can't issue common stock. And if you have enough money to survive, that's fine. But that lack of access to the capital markets frequently triggers a ratings downgrade from the ratings agencies. This wouldn't be a problem if you hadn't written those credit default swaps, but you did. All of a sudden, this is a huge problem. You need to come up with $10 billion. You don't have $10 billion, okay? Or if you do have it and you spend it, you won't be able to do the ordinary things in your business that you would use that $10 billion for. So now you go call Henry Paulson. Go call the Federal Reserve. They're the only people who are going to give you any money. All right. So I call Hank Paulson up and I say, hey, Hanky, give me some money. I need a bridge loan until I can sell off my aircraft leasing business. That's basically what AIG said. And Hank says, sure, we'll do it. We don't want you to file bankruptcy. That would trigger the nuclear weapons, all these ticking time bombs out there in credit default swaps. Can't have that. So we'll give you the bridge loan, but we want warrants for 99% of your stock's current outstanding float. Essentially saying we're going to, you're going to have 100 times as many shares as you did before. Your current stockholders have 1% and we have 99%. Here's the problem. As a hedge fund manager, I can now destroy any company that has a potentially negative capital position in credit default swaps by doing this. What Hank Paulson has done is just enabled bear raids on every company in the United States that has significant CDS exposure. There's no problem with them writing the bridge loan, folks, but there is a problem with these warrants unless they are conditional and only valid if the bridge loan is not repaid in a timely fashion. Then I can support it. But in the present form, as it currently stands, no. Because the risk here is that every single firm that remains on Wall Street and is independent, commercial banks, investment banks, there's only 2 left, but hey, but commercial banks, folks, along with any other large company that wrote this kind of protection, all of a sudden become subject to being taken out and shot in this sort of fashion. This is the problem. This is worse than moral hazard. Moral hazard is bad enough. We bail people out. That's called moral hazard. This is worse. This is effectively painting a target on the back of every firm that has written this kind of protection. Folks, you only thought moral hazard was bad. In the coming weeks, what you're going to see is systematic destruction of these companies. Because if they were to reinstate the no shorting rules, which is effectively what they were, by the way, they ain't going to stop anybody. They'll just write 1 billion puts. We'll buy 10 million puts. And the market makers still can short. They have to be able to hedge off that risk. Buying all those puts does exactly the same thing. Okay? So what Hank has done is gone beyond moral hazard into giving everyone out there, all the hedge fund managers out there, a license to destroy, literally, for profit, every firm that has written these things. If you're a shareholder in a firm that has CDS exposure, that has written credit default swaps, you need to sell your shares tomorrow. We're going to get a big update tomorrow, probably huge, probably plus 200-300 points in the Dow. Okay? Use it. Look into what you hold in your portfolio right now. If you hold financials that have potential exposure to this, you need to get out of those shares in the morning. Because this is open season. He's issued a hunting license to every hedge fund in the United States. Unintended consequences. They're a real bitch. Have a good evening.